Have to have a sip of that, but we got to stay focused because we're talking about a serious issue. We got Sunny Vig in the house here talking about mortgages, and we're specifically talking about first-time mortgages. So why don't you just talk a little bit about your background so we know what we're dealing with here?
Yeah, of course. So my parents have been in the mortgage business for many, many years. Yeah. So I knew what I wanted to do early on. I got my mortgage license when I was 19 back in 2009 while I was going through university. Once I graduated, I decided that the bank is probably the best route. So I started working with one of the big banks as a mortgage specialist there. Okay. And then my family and I decided to team up and join Canada's largest mortgage broker network, and we've been doing that ever since. We have a team of mortgage specialists in Edmonton and Calgary, and we're doing a ton of mortgages. So
you have the qualifications to just talk about this first-time mortgage, because I get the sense, I remember when I bought my first house, it seems it's a lot. It's a lot to swallow. There's all these papers. It can be quite confusing. So what's the first step someone should do when they're considering buying a new home?
Yeah, so typically what you want to do is you want to speak to a mortgage professional. Yeah. And the reason for that is you want to be shopping with a budget in mind. If the mortgage professional is doing their job properly, they should be able to let you know how much you can afford based on your income and your liability load. They should also be able to let you know if they see any potential hurdles or speed bumps in your application. Another great reason is they can also hold your interest rate for up to 120 days. Okay. So you're shopping with confidence, knowing that your rate is secure. Once you've spoken to a mortgage professional, it's then time to go shopping with your realtor. And I mean, even if you're not ready to buy right now, it's a good idea to come talk to us, just because you can get the mortgage planning stage started.
Okay, so obviously to get to that level, to know what you can buy, what your level you can buy, what kind of information will I have to submit to you to get that? Yeah,
so typically lenders look at a couple things when they're issuing an approval. One of the major things is they look at your credit rating and your credit history. They want to see if you're willing to pay back debt in a timely manner. So that's a major factor. Another factor is your employment. They want to make sure that you have steady, stable employment, and you're able to actually afford your mortgage payments. Now, they do look at a couple other factors. They look at your net worth. They look at the property that you're buying, stuff like that. But typically, if you're putting less than 20% a down payment, then they're going to look at your credit and your income. Now, if you don't fall under that umbrella of having perfect credit or stable income if you're self-employed or on commission or contract basis, we do have solutions for you as well, but they typically just require a little bit of a higher down payment.
What am I looking at for cost?
Okay, so for first-time homebuyers, now I see a lot of first-time homebuyers overlooking some costs, so they don't necessarily plan for these costs. Now, you have that minimum 5% down payment. On top of that, you're also looking at paying for the legal aspects of the transaction. So these legal fees can run you, $1,200 and up, depending on the purchase price of the home. Also, a good idea to get your property inspected, through a reputable inspector. That'll run you in the ballpark of about $500 and up. Again, depending on the size and purchase price of the home. Now, you also have to factor in costs associated with moving into your new house. You got your costs associated with hooking up, services and utilities and all that, right? Once all that's out of the way, you got your mortgage payment, obviously. You also have to pay property taxes. If it's a condo, you'll be paying condo fees. And you also want to keep a little bit money aside for things like unexpected maintenance. Right, hot water heaters, you know how it is, roofs and stuff like that. So, I mean, another cost a lot of first-time home buyers do overlook is the mortgage default insurance premium. So, again, in the grand scheme of things, it's probably going to equate to a couple dollars extra, on top of your mortgage payment. But it's a good idea to, be prepared, and so there's no surprises.
How do I know how long I should get a mortgage for? A year, 5 years? What kind of advice do you give out? Yeah,
so typically it really depends on your situation. If you know you're going to be living in that property for up to 5 years, you want to go with especially now, you want to go with a 5-year, probably a fixed. If you don't know, if you're unsure, it's best to maybe get a shorter term or maybe a variable mortgage. With a variable mortgage, you're looking at paying a little bit less of a prepayment penalty if you do break that mortgage. With a shorter term, obviously you're locked in for a little bit shorter. So it all depends on the situation. We'll sit down with you and we'll discuss your situation and what your future goals are, and we'll go from there.
Sunny, great information, and I appreciate it.
I appreciate it too.
All right. Great stuff. We're going to take a quick break here in Dinner Television. Lots more still to come on this edition, Friday night edition of Dinner Television. Stay with us, Em. We'll be right back.